Okay. So, hi everybody. So we're just going to continue on. In terms of syndication deals, because I've seen a lot of that. A lot of people have asked questions about that because now, the whole multi-family craze, and then people wanting to park their money in different sources. If you want to do a syndication deal, especially if you're going to be dealing with accredited investors, I definitely encourage you to talk to a syndication attorney. We usually refer people to Jen Throwbridge or Jillian. I don't know if Jillian Sedati is still practicing because I thought I saw something where she retired, but you definitely want to talk to a syndication attorney to know what all the rules are about working with accredited investors. They have rules and laws in terms of making sure that if the person is accredited, that they have at least $250,000 in income or more than 1 million in revenue. And then you also need to look at the way that the management is going to be structured. Usually you have at least 3 entities going. You have the management entity, you have the entity which collects the funds, and then the entity that purchases the property. So syndication deals are good. I've seen a lot of our clients do it, make money. Some others have done it, lost money. Just make sure that you're doing your due diligence, and then keep at the back of your mind that you do want to talk to a syndication attorney. Estate planning and trust. Yes, it's very important that you start to look at your estate plan. I just talked to a client that did their annual business meeting today. At least get your will set up, your advanced healthcare directive set up, that you have a trust set up. Now, keep in mind that a trust does not protect you. A trust does not give you legal protection. It only helps you with privacy and with avoiding probate. So you have to know where a trust comes in comparison to how an LLC comes in. So usually the best thing is to have an LLC set up and then have the trust as a member of the LLC, and then have yourself as the beneficiary owner of the trust. So that structure usually is enabling you to get the best of both worlds. But in a case where you have an LLC, you're able to add your beneficiaries to the LLC by making them members. Because if you have 99% of an LLC and your beneficiaries have 1%, they still have the first right of refusal if anything happens to you. So you could avoid probate by having the members, the beneficiary owners, as members of the LLC. So it doesn't only have to go through a trust and put in your assets there. Another thing to keep in mind when the issue of assets and transferring assets and all that, if you transfer it to the beneficiaries, because some people talk about, hey, what about, Medicare and the 5-year requirement, and I don't want them to look at these assets and stuff. Remember that if you transfer a property to your beneficiaries while you're still alive, they get it at your basis. But if they get the property when you pass away, they get it at a stepped up basis, which is the fair market value at the time of your death. So this helps to bring down the capital gains. So you do want to keep that in mind as you start to look at estate planning and trust. Tax incentives for property improvements is really straightforward. One of the things that you need to keep in mind is that when you do have property improvements, we want to break it out into 3 ways. 3 ways: is it a repair, meaning that it keeps the property in its current rentable condition? Or is it an improvement, something that is 15 years or less, like a roof, not a roof replacement, but maybe where you fixed the driveway? Or is it something that increases the value of the property? In that case, it's 27.5 years, like a roof replacement. So whenever you have improvements that are done to the property, we have to split it out 3 ways. And those 3 ways: is it a repair? Is it an improvement? Or is it something that you get added to the bill? There's also a 3rd category: is it FF&E, personal property, which is anything that you can move out of the property and not cause a structural damage. So that's really how we look at the tax benefits of improvements. And then based on which buckets is in, depending on the depreciation that you're able to get, that ends up impacting your tax liability. So I've covered about 3 of the topics that were included here. So we will go back to Casey. How are you able to manage your political position and having a full-time real estate career? You're a superwoman.
Well, time would be my kryptonite. I would not tell you that I manage it well, but one of the things that having a real estate career allows you to do is dictate your time. So if any of you all work for yourself, you know that when you are your own employer, you work more hours than any other employee. You're going to work 24 hours a day, but you get to decide which 24 hours it is you're using for what. And thankfully, that allows me to show properties to clients if it's early in the morning. I'm a little unorthodox. So if I need a client to be able to see a property at 8 a.m., I'm not opposed to doing that. There's lots of folks in my field that have set times that will just only stick with those, and that's fine. For me, in my own mind, I'm trying to build an empire, so I don't limit myself in terms of time. If we need to go see a property at 9 p.m., we can do that, as long as we've got the approvals to clear it. So sometimes that may mean that I'm in a town meeting or I'm meeting with the governor, and then I leave there and go show a property. And so I make sure my clients are aware of what to expect. Usually I'm in professional attire, but I might be leaving a property inspection that's in Winchester, right? And I need to come, and I might have on workout attire, and I just prepare them for that. I would add to my political life is that I'm also a single mom of a child with special needs. And so that was really important to me to have additional flexibility with my time, because that's a full-time job too. And if you ever see the work of single moms, they are incredible. And I also, put this caveat that there are some single moms who are married. So don't ever discount that too, or just single parents. But there's a lot involved on any given day. I will say that it helps that I love planning. So I have a calendar. It makes me feel happy to see it filled all the way out for months at a time, because I know exactly where I'm supposed to be and when. And then in my mind, I'm a scenario planner. So if this happens, I'm able to figure out what do I need to do for this. So calculating and planning your time is really important. But then also having the autonomy over your time is the most critical piece, because I get to decide who I want to work with, when I want to work with them, and I can fit that into when I'm doing the work for my time.
Thank you. If you guys have any questions for Casey, you can start to type it in the chat, or you can speak up. The way that we're doing it for those that are coming in is we will talk to the mayor about what she does in real estate, outlook, all of that stuff, and then I will continue to answer some questions. If you guys have any questions, any additional questions based on what I've already shared, please feel free to post it in the chat. So I'm going to give a couple of minutes. Does anybody have any questions for the mayor before we move on? Okay, you can go ahead, Marilyn. Hi, Marilyn. Okay, Pierre is asking why we may wait from, Marlene, sorry. Does one seem to take more time or energy than the other? So I guess it's balancing being in real estate, doing it full time, and then being a mayor. Does one seem to take more time or energy than the other one?
No, actually I would say they're almost equal to time, energy, aggravation. There's a lot people don't understand about being in the real estate field. They see home and garden television, they see like the luxury shows, the things that Netflix put forth. And so there's this concept that you just go show a really pretty property, somebody buys it, you get paid your commission. And that's really not the case. If you're going from inception to the close of the deal, this is kind of like hand holding and walking with a gentle egg all the way through the process. And you can get to the end of the deal and there'd be no money there. There's so many laws that you really should have a legal understanding, and it's required that you get lots of training, but many people don't pay attention to the information that they get in training. So I would say that it's equal amounts. Doing my public service work for the town, there are 6,200 people I'm responsible for. They all have my phone number and they use it. And they use it 2 or 3 o'clock in the morning, and it's my job to be responsive. So I would say both jobs are equally challenging. They're also both really fulfilling, right? I love working with minorities who are the first people in their entire family to get homes. I love working with investors who are able to see where they can add benefit to community, but also are setting up, generational wealth for their families. So there's a benefit, there's fulfillment to it, but it's lots of work as well for both.
Good. So Marilyn is asking, what are your thoughts on tax liens and tax deeds? I'm thinking of using that to help me get into real estate. You want to go first, Casey, and then I'll respond.
Sure. I would say that it's a viable way to get a property, to use tax liens and deeds. It is not my favorite way, because at any point in time through the process, the person can come up with the money to pay for the lien or the deed. And then you've invested all this time and energy in something that you're not going to get. So I think a market where it's really good is Baltimore, if you can stay in Baltimore. If you are on the East Coast or in the Maryland state, then that's a good place to use them, because most of the folks that end up with a lien don't pay it. So you're guaranteed to get your property. But and the DC has been a pretty good area if you can do it and fight out other bigger investors. So it's a good way to get your toe into the market for sure.
Okay, thank you. I was looking for the chat button, the mute. So thank you.
I think I love tax liens and tax deeds. For those of you that don't know, there's about 15 to 20 real estate strategies out there. So for me, because 95% of my clients are real estate investors, I've seen all of the strategies, and I can 100% say that all the strategies work. If you use the right principles, the right tools, the right team. And so you can really make a lot of money using tax liens and tax deeds. My suggestion is to make sure that you analyze it. Well, this is something standard for real estate. Whether you're a landlord, or you're a wholesaler, or you're a rehabber, or you do notes or commercial, always have 3 exit strategies. This is one thing that I learned from Sherman Ragland. Make sure that you have 3 exit strategies. So you don't necessarily just want to analyze the tax lien and tax deed from the perspective of, oh, I'm going to get the property. If you analyze that, that's just one exit strategy. And like Mayor mentioned, if the person ends up redeeming the taxes, which a lot of people end up doing, then you didn't really make the money that you were expecting, and you could have put in the kind of time and effort that you put in thinking that you would get the property. But you want to analyze it for just the pure interest that you're going to get off of investing in the tax lien and the tax deeds. Because when you purchase that property from the county, in order for the person to redeem it, they have to pay the taxes and also pay the interest. And sometimes it comes out to about 15 to 18% that you're going to get just on your just off of the taxes. Now, places like I think Montgomery County, where there's this surcharge or additional amount that they require you to pay, it may now be from 18% to be like 8%. But at the end of the day, make sure that you're analyzing it where if they redeem this property, is it still going to be worthwhile? If they don't redeem it, yay, I go to foreclosure, all that. You have to look at the foreclosure time. I think I was talking to another client, I think it was about a property in New York, and we found out that, hey, the New York laws are crazy, in terms of foreclosure. When we were thinking about maybe you do a sandwich lease or any of that stuff. And then we realized, the attorney Martin, was saying that it just depends on how you have everything set up. So the whole answer is it depends on how you do it and making sure that you're working with the right team. So I'm going to bring in Celine. Celine, you can, I don't know if you're able to unmute or share your video, but Celine, who's also in the wealth building program, said it looks like you do tax liens in all 50 states. So can we also hear your perspective on that?
Hi, Iberi. Hi, everyone. I'm sorry I'm having a lunch, my late lunch and speaking, and just happened to see your call. I say, oh my God, this is so interesting and down my alley. I'm an immigrant. I'm a realtor as well. This year will make it 30 years, and I'm about to hang my hat. And I'm about to start coaching, actually. And one of the things I want to talk about is buying tax liens and tax deeds across the USA. So if anyone wants to get some more information, I'll be releasing my ebook soon, and it will be tied with all of this. So if it's okay with the Barry, I can provide my info. I provided my phone number down there already in the chat.
Yeah, that's fine. And then when the ebook is ready, just send it over and then we'll have Yasmin do a blast.
Oh, thank you so much. Thank you.
We have 2 questions. Lynn says it depends on the state and working with states that have a shorter redemption period. I agree. And then
Correct.
also, I think this one might be for you, Celine, whether you can JV on tax liens and deeds.
Yes, you can. You sure can. And maybe very soon I might will connect with Ibere, and I will actually bring my coach, who is an expert on tax liens and deeds, and he's bought over 3,000 of them within the last few years, and helped a young lady go from Section 8 homeless to being a millionaire in tax liens and deeds.
Awesome.
Mm-hmm.
Thank you, Celine. Thank you.
Thank
you. This is the power of networking and, having a good network and people that, that's one thing I tell people. I promise you that any question that people have on real estate, I know somebody that knows something about it. I may not know, but somebody knows. That's the power of proper networking and knowing the right people. Okay. So let's answer a couple of more questions while we continue. Investment strategy, maximum allowable offer. Okay, I know that there's people on here who are much better than me than this. What are you guys doing now for Mayo in terms of your maximum allowable offer? Is it still 70% after repair value in this market? Is that what you guys are using? Or is anybody else using? We can throw that out and see. What are you guys using for your Mayo?
So when you say Mayo, you're talking about the purchase and the rehab and then the ARV, right?
Yes. What offer? How much when it comes to investment right now in this market? What are you basing your offer on? So what's the maximum that you offer on a property? Is it still at the 70% of the after repair value?
Yeah. And I go really aggressive with the repairs. Like it could be a $70,000 repair, but I might say 130. Because I'm finding repairs are tending to go over time and over budget. And when you're doing hard money, you don't want to be caught in a bind. So really, really overestimating those repairs and then, and then coming in with an offer that makes the most sense, I would say.
Awesome. Thank you. All right. Somebody asked a question about how to create a family office. We're actually going to have a meeting about this sometime later. I don't know if we're going to do it now or do it in November towards the end of the year, because I've started talking to different people about the family office. I came out of my training was out of a family office. For those of you that don't know what a family office is, it's really an arrangement where you have all the different professionals come together to look at your finances and everything that you're doing, your finances, your legacy, everything that you want to do to build wealth or transfer wealth, and then to help you set it up. So it's going to be an estate planner, it's going to be an attorney, it's going to be a CPA, it's going to be a financial planner, it's going to be an advanced tax strategist, it's going to be those who do specialized investments, it's going to be those who set up the charitable fund or the donor advised funds, or even creating a nonprofit. So all these different experts come together. One of the discussions that we're having, because most family offices would not even touch you unless you're at the exemption level, which is about, the inheritance exemption, 12 to 13 million. But we're saying, hey, there's a lot more people who are making less than that, and they need the family office services. So I've been talking to Ryan. Some of you know Ryan Foncannon. That's what he does. He's a virtual family office. And we're looking at what are all the components that we need to put together so that any regular person who wants to set up a family office has this. They have access to the array of all the experts that are out there, including exit. They have exit, what do you call it? Exit advisors. If you want to exit out of your business, how to convert that business into something that you can sell, get the money, walk away. So we will be talking about a lot more about the family office. I'm not sure if I can pull it off before August. If I don't, we're going to do it definitely November, December to start talking about it. Next, tax benefits of a K-1. I'm very, very happy that somebody asked this question about the tax benefits of having a K-1. So here's what happens. When you are in a partnership or in an S-corp, you could be a limited partner. And so you might be a limited partner, like if you do the syndication, somebody asked about the syndication, and now you're a limited partner, and that limited partnership maybe generated about $20,000 of net rental loss, or even net business loss for the year. And you're thinking, oh, because I get a K-1, I'm able to use that $20,000 loss to offset income that I have from other sources. You absolutely cannot, because you're limited, except you end up having passive income or income from other sources, or that partnership shuts down. It's just going to go into the passive activity loss bucket until that K-1 is closed. So a lot of people have made a mistake, like you'd invest $100,000 or $150,000 in a syndication, and you're hearing everybody talk about all the tax benefits. Come tax time, you realize you're not able to use it because you were not advised properly that if you are a limited partner, meaning that you're not actively managing that partnership, it's going to be limited and you're not able to use your losses. So the tax benefit of a K-1 comes if you're actively involved, but you're also able to do income splitting with a partnership than you can with a single member LLC or sole proprietor. By the way, I know you guys have always heard this. Single member LLC, sole proprietors tend to be audited a lot more than any other entity structure. But with a partnership, we're able to split your income into 2 or 3 different buckets. You have the passive bucket, you have the active bucket, and then you have a bucket that could be passive where we have like interest or dividends that you're being paid. So it's very important that when you hear something in front of the room saying, hey, invest in this partnership, you're able to claim all the losses, they may just be talking to full-time real estate professionals. It may not apply to you. Make sure that's the whole team concept about having people like in the wealth building program, because you're able to have somebody look at everything and advise you, and not just based on what you heard in front of the room. Because just because the person speaking is able to get that deduction doesn't mean that you can get that deduction, because they're a general partner and you're limited. And a lot of times people don't know that. Okay. Let's see, travel expenses. Okay, we'll leave that for last because that's general business expenses. Let me see what questions we have on here. Oh, we have a lot of questions. Okay, so here's Pierre. Thank you so much for taking the time to speak with us. Pierre, who are you talking to, me or Casey? Because I know you're not talking to me. I know it's Casey you're talking to. Okay, is there increased legal risk given that you are known publicly? Are people more likely to try to sue? Okay, you can start with that first.
There's increased risk, not necessarily for lawsuits. So I don't typically, when I'm working with my clients, I typically don't tell them that I also serve as the mayor. I try to have some level of anonymity, which is really difficult to do because the minute you put somebody's phone number in your phone, it populates on social media. And I have really active social media for all parts of my life. And so there are issues. One of the things I do is I don't do any commercial real estate, which is a huge chunk out of, my portfolio that I could do. But I don't, just because there's a couple of challenges that come with that. With the municipality that I lead, we are set to annex a property that is going to be $550 million of an investment for the county. And I can't be doing commercial real estate where people think I'm trying to get backdoor deals, if you will. I also just have to be very mindful because there are ethics requirements that I have to follow. So if somebody says, can I take you out to lunch? I literally have to ask, well, where are we going? Because I can't accept a gift that's over $20. If I do, I have to disclose it, and I have to be mindful with that. So, and that can sneak up on you, right? So like one of the neighbors that we have to our municipality is Amazon. Amazon, for the holidays, one of the executive vice presidents gave me a huge sort of chocolate motif, which was beautiful. And I said, thank you. And then I had to think about it. I was like, was this more than $20? I had to give it back. So I do have to be very cognizant of ethical obligations and violations that might be considered. I have to reveal to the public my financial standing and holdings and whether or not I have any business that's done in the county or my municipality, because you should not use, and you cannot use your position to enrich your personal life. So to that question, yes, I have to be very careful.
All right. Are there certain types of real estate that is less compatible or that you should avoid? I think you already mentioned the commercial. Any other types of real estate?
I wouldn't. So the commercial is really important, but also like if the person is not going to be using the property for what they deem, when you are somebody's representative, you could be held accountable. So this is the first time I've ever seen it happen, but last year was the first time I saw people who purchased a rental property. They actually lived in that property with the intentions of turning into a rental property later. And they bought a new home and then they rented the property out. I got them their renter as well as sold them their home. But I did not know for the first home that their loan said that they were taking advantage of the homestead tax credit and that they were going to use their home as their dwelling. That is the first time I have ever seen a bank call a loan, but they called the loan. And so they had to immediately sell their property. So just for those incidents, I'm not necessarily the person on the chopping block, but my clients certainly would expect for me to know, could this happen to them, and to properly advise them, if you're purchasing for this purpose, this is the type of loan product you want to talk about with a lender, because you can end up losing your property or having other issues go along with that. So I would say commercial, I stay away from entirely just because it could get me in a ton of trouble. But then also just making sure whatever dealings you do, they're above board.
All right, last question. Any special challenges with interacting with people wearing those two different hats, as a public official and then as a property owner or realtor?
Any special challenges, man? Well, people. And the minute you interact with
People dealing with humans.
I think that one of the challenges for both fields is this is sound really, really terrible, but I don't actually think of myself as somebody who's really smart. I'm just like, I know this, I know a little bit about something to be dangerous and everything, but I don't think of myself as someone who's super intelligent. So my assumptions about what people are aware of and know is kind of limited. One of my first clients, when I started real estate, they asked me, hey, we got a pre-approval from what was then Wells Fargo. Wells Fargo used to be Washington Mutual, I think, and then they got bought out or something like that. So they had a pre-approval letter from that one bank, and then they got another one from like Bank of America. And they asked me, well, since we have two letters, can we buy two houses? And it took me forever to try to understand where they were coming. I couldn't figure out, the data that was used for one letter is used for the next. And so I had to, really take a step back and think to myself, I don't know what people don't know. So I treat everybody, whether it's a client in real estate or somebody who's talking to me about a bill that's going forward in the General Assembly. I treat everyone like they may not know about this topic. And, and I ask for forgiveness. Like, I don't know if you already know this or not, but here's the reason why we don't have enough police officers. Here's a bill that says I have to have a supervisor and 3 officers on duty at the same time. We spend $3 million a year paying for that. We don't have enough money to pay for these people. Like, just spelling it out so that it's almost like you're talking to kindergartners, but in a very respectful way. so that there's a good understanding, because you just don't know what people don't know, you know? I had someone ask me, well, if I got my credit better, could I buy a more expensive house? And I said, no. The issue with the house and what you're able to afford with what you bring in every month. So your credit could be great. You can have an 800 credit score. If all you make is $2,000 a month, then the bank is not going to let you get a loan for more than 48% of what you bring in a month, because they know you're not going to pay your mortgage, even if you have a fantastic credit score. So things that you might think are common sense, everybody does everything that common sense isn't common. So just knowing that. The other thing is, and I think it's important to note, just because it shocked me and it shouldn't have, is racism. I have gone to properties where the owner has been there and they were like, are you the one showing the property? And I said, yes, you know, I called and arranged with either you or the agent. Oh, well, you can't come in here. And that's been a shocker to me. It was a shocker to me when I ran for office. I'm the first Black mayor for my town. And that made some people uncomfortable as well. So just, it shouldn't be shocking, I guess, but even in 2023, I'm always surprised when I encounter people who, you know, are still bigots and racists. So I think those two are the two things to keep in mind. Yeah.
Thank you. Okay, so continuing on, if you have any questions, whether it's taxes or anything else, or any questions for Casey, please post it as I continue to answer our questions. Okay, so somebody asked about travel expenses. Whether you're talking about travel expenses or cruise or education, expenses like that, you know, that tend to be high and can have the personal and business aspect of it, you are only allowed to deduct the portion that relates to the business. So if you go on a 5-day cruise and one of those days is the business meeting, well, only 20% of your travel expenses is deductible as a business. If you travel for a real estate convention and maybe at the end of the year, you have not yet purchased a property, in some instances, we may end up amortizing that travel expense until economic performance occurs, meaning that the whole reason why you went into the convention, which is to be able to do more deals, actually materializes. Then we can deduct it in that year or amortize it over time as startup expenses. The kind of operating agreement that you have is also important. For example, when you have expenses that are related to education, the rule is that if the education that you are engaged in improves your skill or your value, you're not supposed to deduct it. But if the operating agreement for your LLC states that you are required to engage in education, knowledge, learning that would help you maintain your position as the managing member of your LLC, then it becomes reimbursable. Because the LLC, your business, is reimbursing it, you're able to get that as a deduction. You can also set up an accountable plan for travel. You can set up an accountable plan for education, for mileage, for meals. So that's another way that you can set things up in order to be able to claim the deduction. But at the end of everything, what I tell people is that the goal of every business is to make money, not lose money. So a lot of times we spend time talking about what can I deduct? Oh, I have this expense. So if I buy this $80,000 car, can I get section 179? Or if I take this cruise convention, am I able to write it off? My question usually is, what is the business purpose of this expense? Because if you spend $80,000 and you're only getting a 30% deduction, that's $24,000. You've still spent $50-something thousand at the end of $56,000. Was that money that you would have spent if you were working for somebody else, or if you were my partner? Would I want to continue being your partner if I know that you spent $80,000 on a car when we got marketing to do, when we got systems and all that stuff to set up? So these are questions that you need to ask yourself. It's not just looking at the tax impact, but what is the business purpose for engaging in that expense? That's the reason why when you get audited by the IRS, they are asking whether it is ordinary and necessary business expense. Because I see a lot of people who make decisions about what to spend based on the deduction, but the deduction is only a percentage, you know? I see Casey shaking her head, so I'll let you speak about that, you know? So if you have $100,000 and you said, oh, I'm gonna spend $60,000 because it's a tax deduction, well, you're only getting, depending on what your tax rate is, federal, state, and in some cases, the Medicare surcharge, you're only getting a percentage of that back. The rest of the money becomes a sunk cost because it's not really going to contribute towards the production of a profit or generation of revenue. Casey, your thoughts?
Could not agree more. And you want to make sure you consider the percentage of the cost. You know, what they say is your net work is your net worth. And so thankfully I've had some tutelage from Iber, but I put an office in my basement because I conduct business as Casey Munyene, but also that goes into my company's name. And so in doing the work, I said, well, assuredly, I'm going to get this back dollar for dollar. So I used high-end items, right? This is going in my basement in my home, but it's also my home office. You can imagine my disappointment when I learned I could not use it dollar for dollar. So you just want to be considerate of that. Is this a purchase I would make regardless? If it's a purchase I would make regardless, then you know, by all means go ahead. But if it's something you're making thinking, oh, I'm going to get this back, be very careful.
Yeah. And Eric says, me too, I've been threatened directly in terms of racism when out in the field working on real estate. It's amazing, regardless of your color, shape, size, where you come from, you can get discrimination. So let's talk about that a little bit. As real estate investors, how have you overcome discrimination? I'll start. I don't care. Yeah, I feel that I surround myself with the right people. I'm learning. I'm actually taking a course now with John Maxwell, and he talks about leadership. And one of the things that he talks about leadership is your attitude. You know, that your attitude will take you further than any other thing. So I look at discrimination as my circumstance, but I don't believe that my circumstance is going to be the determining factor in where I need to go. I remember when I was working, you know, in corporate America, and I got passed on for a promotion. It was given to somebody else simply because I was married, I was pregnant, I had a kid coming, and my manager didn't think I could handle that position. But guess what? I would not be where I am today if I had stayed at that job. So it kind of launched me into where I needed to be. So I think it could be 20% discrimination, but 80% your attitude, how you handle it. You know, there's 7 billion people in this world. If one group of people are discriminated against you, please just walk across town or go somewhere else. That's one thing why I love real estate. I really love real estate because I've come to meet a ton of people who are very, very open, teachable, are able, you know, they're very respectful. I'm also respectful. And there's people who would like to discriminate, but naturally those people would fall away, because if you're about the right thing, looking at generating your income, looking at helping yourself, improving society, helping, those that are not right would eventually fall away. So I don't know, not that I don't take it seriously, but you know, if you ask Casey, I always let her know, I don't care. I bring the energy. I'm the what do you call it? I'm not the thermometer, I'm the thermostat. I literally have that kind of self-esteem that I bring it. I can bring it. So I'm not allowing you to discriminate or allow that to impact me. There are people who are in worse situations than we are, and they've been able to find a way to make it. So I try to like shrug that off and keep going. Casey, wouldn't you say that too, that you've been able to rise above these things to get to where you are?
Yeah, I think that's a valuable life lesson, which is, you know, if I look at my political career, it took me a little while to realize that I had really loud naysayers, but there weren't that many. So when I started counting the number, it's just really loud 5 people, right? So then I'm like, well, they're not going to stop. One monkey doesn't stop one show, right? So that those 5 monkeys wouldn't either. You have to have grit, though. You have to have the positive attitude to be willing to move forward. In the real estate field, I think it's been more fascinating to me from sort of the position of being able to study people, right? So I've had someone who's a Grammy award-winning artist who makes $1 million a year not be able to qualify for a loan because of how he makes his money. Meanwhile, I've had, a couple who work for Amazon and one who is a teacher, credit score 520, be able to qualify for a loan. And so you look at those things and wonder, well, how is this happening? And sometimes you're able to come up with a decent explanation based on the numbers, and sometimes you can't. So I'm glad that you point out that there's at least 20% of it that has an impact, because it does. People who are actuaries, most boring job in the world, come up with how we get interest rates for certain things or how we get policy rates for things. And race is a factor. We can't ignore that. But that being said, whoever won't let you in one house, somebody else will let you in the other, and you just keep moving. I think for me, what I had to overcome was just the shock, right? Because I'm in a field where most people are just worried about green and nothing else. So to see that there was an incident like that was just a surprise for me. But get over the shock, and then make your green. That's the most important thing, is move on to the next thing.
Yep, it's all about the Benjamins. Okay, we're coming down the pike here. Lynn says, with interest rates on the rise, is it better to buy properties in your name versus LLC so that you can refinance it easier when the time comes? Refinance rates for LLCs always seems higher and difficult. Yes. So for me, my suggestion is it depends on what your goal is with the property. If your goal is to refinance at some point, it does not make sense putting it in your LLC, because you're going to have to pay transfer taxes to get it out. First of all, to get it into the LLC, then you're going to have to pay transfer taxes, recordation taxes, index taxes, attorney fees to now get it back out in order to refinance. And a lot of times when you're doing finances in an LLC, they usually charge you portfolio rates, not residential rates. Residential rates are much lower. And so the suggestion that we usually have, if you're Prince George's County, Montgomery, not so much, Baltimore County, where there's a high transfer taxes when you move a property from your name into your LLC name, is keep that property in your name, get a really good umbrella policy, put a second lien on the property if you need to, get a different property management LLC that handles all of the property management. Then when you're done with everything refinancing, then you can put your money, you can put that property in an LLC or a trust. But guess what? I tell people that a lot of times as investors, we are so afraid of lawsuits that we're not worried about the taxes. Like you're being sued every April 18th, if you get what I mean. Uncle Sam, the Alphabet Boys, they're coming after you every year, and you're not as concerned about what the Alphabet Boys are doing that you're concerned about a lawsuit that may or may not happen. So the thing about lawsuits is that when it happens, it's really huge. But taxes erode your bottom line in small trickles. So if you were to set up an entity, always think about three things: the tax impact, the asset protection impact, which is the entity structuring piece of it, and the ease of compliance. So for me, I would be careful in putting a property in an LLC just yet if I know that I'm going to refinance, because of all the fees that I have to incur to get that done. Ends up becoming, the compliance cost ends up becoming, it's not cost effective to do that. Okay, so Michelle has here, can I move a property that I have previously owned into my recently formed LLC? Yes, you can do that, assuming that you've addressed all the things that I just talked about. When we work with clients in terms of asset protection, entity restructuring, I usually want to find out what's the fair market value of the property, what's the loan balance, what county is the property located in, because that determines the laws that would govern. If it becomes difficult, and then also, what are your goals? Are you planning to refinance anytime soon? Are you planning to sell? Then we make a decision. If all else fails and we can't, umbrella policy, lien, use a property management company for dealing with the tenants, make sure that everything is done in the name of the property management LLC. Never represent yourself as an owner. Always represent yourself as the property manager. Talk to yourself. If a tenant calls, hey, I need a discount, you be like, oh, let me call the owner. Hang up the phone and go talk to yourself. Barry, the tenant said this, and then Barry goes say no, then I'm gonna come back and say, oh, the owner said no. As long as you're not responding to yourself, just, so just make sure that you separate out the property management. But in terms of that decision, is going to be what I said. What is the cost of doing that, depending on the county where your property is located? All right. This is my first meeting here. I'm really enjoying it. How do I get on the list to receive these consistently? So this meeting, we invited a couple of people to join to kind of see what happens behind the scene. This is a meeting that we do for those in the wealth building program. These are people that sign up and they get all of our services for the 1 year. We have these meetings May, June. They have the one-on-ones, but in addition to that, they have the group meetings. We usually leave out the last meeting where everybody, whether or not you're in the wealth building program, can come on. So if you want to get it, and usually I still do meetings for everybody where we send it out. But for the last 4 weeks, we've only just dealt with those in the program because we want to make sure that we're giving them the services and answering their questions. Okay. Also, this is going to be recorded. And so you'll have it on, you can like our YouTube page. We're going to send out the YouTube link and all that where you can watch these. What about setting up a trust if you have one property in an LLC and two that you manage? Again, remember, a trust does not give you legal protection. It only gives you privacy and helps out with estate planning. So that's something, Flo, that we might need to schedule an appointment for us to flesh that out and unpack it to see what role this trust needs to play, because it definitely cannot take the place of the LLC. It could act as a member of the LLC, but in terms of being what you have at the forefront, usually I don't advise it. Monica is asking, is anyone familiar with a spendthrift trust? I am familiar with the spendthrift trust. There's several trusts that are out there, but I always tell people to be very careful in terms of how it's set up, because some of these trusts are set up so that you have the separation. So it's helped you with your legal, but then you come to the tax side, you end up paying all these tons of taxes because the trust tax rate is at 35%. So yes, you've separated everything out so that nobody can come after you. The trust, there's a trustee that makes decisions, which is good, but then you come on the tax end, you just jacked up your taxes because now you have all these properties and you're doing all these things in a trust. Okay. Yes, it does help to protect against lawsuit. It does not help with taxes. The way that they say it is it doesn't help with taxes because it's unless you take a distribution, but the trust still has to pay taxes. Now you're dealing with double taxation because the trust is going to pay taxes. And when you eventually take a distribution from the trust, you're going to pay taxes again. Okay. Any other questions? We are at 4 p.m. Any questions for Casey, myself? Okay, one, I own rental property and I flip. I'm finding that the deductions I'm taking from the properties is now making it difficult for me to qualify for a home. Absolutely. 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 I'll let Casey speak on that from her perspective. But what I usually tell people, you can't have it both ways. You cannot eat your cake and have it. You have to be able to decide what's most important in that year. If it's important in that year for you to qualify for a loan, then you don't want to be taking all these deductions on your you don't want to be taking all these deductions on your property that's going to lower the net income of the property, thus increasing your DTI, your debt to income ratio. Now, there's several ways around it. Where could it be something that you depreciate rather than expense? Because depreciation is usually added back and calculating the net profit from the property. So whenever you have to make a decision about financing, qualifying for financing, taxes has to be at the back. It's an inverse relationship, and some of these expenses, you don't lose it. You can amortize it and then claim it over, but you can't say, oh, I don't want to pay taxes, but I want to qualify for. Sometimes that relationship doesn't work. So you have to decide, and that's why you usually plan out when you're in the wealth building program, you're looking at a 3-5 year approach. And maybe the first 2 years is to get you to qualify to get the properties. The last 3 years, you can start to write off the amortization or depreciation that you've taken. But sometimes trying to do it both, like I want to qualify, but I don't want to pay taxes. You're kind of like wanting to eat your cake and have it. All right, yeah, the year that you want to buy, you just have to show the income, I agree. And you got to show potentially 2 years if you do not have sufficient W-2 income. So Casey, you want to talk about that? That would be the last thing that we talk about before we round up. If you have any other questions, please post it as we're coming down the pike here.
I would tell you this question is so you asked it, because I have so many clients who actually have lots of money and can't qualify for a loan. They have lots of wonderful investments and can't qualify for a loan. When you are working with a lender, they are looking at your last 24 months of income. And so if you have made deductions, if you have a lot of people who have 1099s or who work for themselves and don't get a W-2, your whole purpose in life is to find a deduction, because you want the person that's doing your taxes to make you look as poor as possible, so you're not paying the government. Well, that's what you look like when you go to apply for a loan. You look as poor as you possibly can, which means that they will not qualify you for the loan. So you have to take the bitter with the sweet. And just like Iberia said, you have to plan things out. So I have one client, to this amazing business owner. He owns several restaurants, millionaire. He's getting a divorce. And so he wants to buy his dream home. And so he said, well, my dad can buy it for me. Okay, your dad does not make $1 million a year. You do. And so I need to be able to prove to the lender that dad has this money. Did anybody have any idea of how we figured out how to do that? Dad had to become an employee. That's a smart idea. But guess what? Dad has not been an employee for the last 24 months. So I still don't have enough income to show that he can actually afford a $997,000 home. So just keep that in mind. Also, remember, you don't know when a good investment deal or a good property is going to pop up. You can always amend your taxes to say that you actually didn't have all those deductions. But that really creates a firestorm if you don't want people looking into your taxes. And it's a whole nother headache and another fee. But if you come across a property that you love and you want to be able to qualify for it, you still have that as an option as well.
Thank you. So just about amended returns, I'm not a fan of amended returns. The IRS start looking at you funny, especially if you're amending where you had, claimed things before. Now you're unclaiming it. You're just asking for an audit. Just make up your mind in the year that you're going to finance that taxes, take that hit. Guess what? You may be paying more taxes, but the reason you're buying that house is because you're building equity. So yes, you may be cash poor, but you're becoming asset rich. Overall, in the grand scheme of things, in about 10 to 15 years, it wouldn't matter what price you had to pay today. Trying to get the best of both worlds, it's not always advisable. Okay. So let's see here. I have a multi-unit building under contract in Ohio and looking for private lenders. Do you know anyone that can help me private fundraise? Just send me an email, Celine, and then we'll do it. We'll get a blast out and see who can respond. All right, thank you, Casey, for being on today. Thank you, guys. This is the last of our annual business meetings. Again, if you're in the wealth building program and you have not yet scheduled your one-on-one, please schedule your one-on-one. These end at the end of June. And July, I'm taking my vacations. August, I'm going to celebrate my 50th birthday. So please make sure you get these meetings in, because I'm not going to be talking to you very soon. Thank you, guys. Any last words, last comments? Oh, I think, Monica, did you have your hand up? Did you want to say something?
No, I got to answer. Thank you.
All right, no worries. All righty, everybody. Have a good rest of the day. Thank you, Casey. Thank you, Mayor. Thank you, everything. Take care, everybody. Bye-bye.